Germany, France, Italy and the Eurozone as a whole released growth figures for the third quarter of 2009. Well, we're crossing over to Paris, where Standard & Poor's economist Jean-Michel Six is standing by to talk to us. Jean-Michel, thank you so much for coming on the show. In terms of what we have seen, it does seem that there is a recovery fully on its way. What are now the challenges facing the Eurozone? Are you concerned that there's a risk that the governments take it for granted and start implementing exit plans?
Well, first of all, we have indeed some positive news from the largest economies of the Eurozone, France and Germany in particular, Italy as well. But don't forget that Spain, Ireland, Portugal are still stuck in a recession as far as the third quarter was concerned. So it's a very uneven recovery yet within the single currency zone. Second, I want to also stress the fact that obviously we will really be out of the trough once unemployment rates start to decline. And unfortunately, most economists and observers agree on the point that indeed that's not likely to happen before well into 2010. Probably not before the middle of 2010, actually, to be specific.
Jean-Michel,
so it's only at the beginning of a gradual recovery.
You're talking about a two-speed Europe. Does this make Jean-Claude Trichet's job that much more difficult?
Well, in theory it would, but past experience suggests that as far as the ECB is concerned, Germany remains a key benchmark, and therefore once we have more signs that the recovery in Germany is well underway, which we expect to see in the coming quarters, thanks in particular to the strong exposure of the German economy to foreign trade, then I think the ECB will feel that it's time now to reverse its stance and start rising interest rates. We expect interest rates to start going up at the ECB level in the spring of 2010. Unit labor costs in Germany have been growing in a fairly rapid pace in the past year, over 5%. In fact, the latest number was 8% on a year-on-year basis.
Jean-Michel,
that's certainly too high for the ECB.
If interest rates start raising in spring 2010, will the exit plans have been implemented by then?
If you mean the fiscal side of the house?
What has to come first? Central banks raising rates, or is it the governments taking the extra liquidity off the markets?
Well, I think what is likely to happen is that the governments will not be able to do very much before 2011. So probably we're going to see the beginning of a tightening on the monetary side before we start seeing anything convincing on the fiscal side. Next year, deficits may stabilize in some countries, but certainly not start really going down before well into 2011. So indeed, it's monetary first and fiscal second, which may not be ideal, but that's the way it is.
So, Jean-Michel, if unemployment is going to continue rising, despite, of course, the recovery, when will jobs become easier to find?
Not before the second half of 2010. Typically there's about a year delay between the moment we technically leave the recession from a GDP standpoint, return to positive growth, and the time when the unemployment rate peaks. That's the lesson from past experiences.
Jean-Michel,
that would suggest at least spring of next year.
Great. Thank you so much for all your comments.